Welcome. Where Ninda, Dumalang, Molo, Sawabona, Hukandat, and a warm welcome to the Indivo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today, we're tackling a topic that might sound a bit dry at first, but trust me, it's got more twists and turns than a taxi ride through rush hour traffic in Josie. We're diving deep into the world of IAS 28, the accounting standard that tells you what to do when you've got your fingers in a few business pies.
Think of it this way. You know how we South Africans love a good partnership, whether it's a spaza shop or a shisanyama joint, or a tech startup, we're all about working together. Well, IAS 28 is your guide to navigating the financial side of those collaborations.
So it's like the rule book for when you're in business with your chummy.
Exactly. But before we get into the nitty-gritty, let's define some key players. IAS 28 deals specifically with associates and joint ventures. Now, an associate is like that friend you've invested in. You've got a say in what they do, but you don't control the whole show.
Like when you lend your cousin money to start a business, but you make sure you get a seat at the table when decisions are being made.
Precisely. You've got influence, but not absolute control. Now, a joint venture is more like that spaza shop you and your neighbor decide to open together. You're both equally in charge, sharing the profits and the losses.
Makes sense. So how do we keep track of all this financially? The document keeps mentioning this equity method. Sounds a bit technical, doesn't it?
It might sound fancy, but it's actually pretty straightforward. The equity method is all about making sure your financial statements reflect the true value of your investments. Instead of just recording the initial cost, you adjust the value based on the performance of the associate or joint venture.
So if my cousin's business is booming, my investment is worth more. But if that spaza shop is struggling, my investment takes a hit.
Spot on. It's about recognizing that the value of your investment can go up or down, depending on how well the other company is doing. And this is important for getting a clear picture of your overall financial position.
Now, I noticed this IAS 28 has been revised a few times. What's the story behind all these changes? Are they just making things more complicated?
Not necessarily. The business world is constantly evolving, and accounting standards need to keep up. For example, in 2014, they had to clarify the rules around selling assets to your associate or joint venture.
So no more sneaky backroom deals with your Jami.
Well, it's not about being sneaky, but it's important to have clear guidelines to ensure transparency and fairness. And then in 2017, they made further updates to align IAS 28 with another standard, IFRS 9, which deals with financial instruments.
So it's like making sure all the different pieces of the accounting puzzle fit together.
Exactly. It's about creating a consistent framework so everyone is playing by the same rules.
Now, this might sound like a silly question, but are there ever situations where you don't have to use the equity method?
That's not a silly question at all. There are actually some specific exemptions laid out in the standard. For instance, if you're a parent company that's exempt from preparing consolidated financial statements, then you might not need to use the equity method for your investments.
So it's not a one-size-fits-all situation.
Definitely not. The exemptions are there for specific circumstances and are carefully defined to ensure things are still above board.
Now, let's get down to brass tacks. Imagine I've invested in a company that's really struggling, like my friend's Shizanyama spot that just can't seem to attract customers, even with the best braai in town. Do I have to keep recording my share of their losses forever? It feels like watching your money go up in smoke, literally.
That's where things get interesting. IAS 28 actually has some specific guidance on what happens when your associate or joint venture is losing money. You see, paragraph 38 talks about how you don't have to keep recording those losses indefinitely.
Okay, that's a relief. So there's a limit to how much financial pain I have to share.
You could say that. Essentially, you stop recognizing your share of the losses once your investment's value hits zero. It's like saying, I've taken enough of a knock. I can't handle any more losses.
So there's a point where you can say enough is enough and walk away from the financial brayfire.
Well, it's not quite that simple. Even if your initial investment is wiped out, you might still be liable for any other commitments you've made, like loans or guarantees.
So it's not a complete escape from the Shizanyama disaster.
Afraid not. Business can be tough, my friend. But speaking of tough situations, IAS 28 also talks about something called impairment losses, which is essentially the official accounting term for admitting your investment has gone sour.
Impairment losses? That sounds ominous. So are there like specific rules for when you have to wave the white flag and admit defeat?
There are indeed. Paragraph 41A outlines some clear loss events that signal it's time to face the music. Things like if your associate is in deep financial trouble, breaches a contract, or needs constant bailouts just to stay afloat.
So if my buddy Shizanyama joint isn't making money and he keeps asking for loans, that could be a sign of impairment.
That's a very relatable example. And yes, it could definitely be a red flag. But remember, it's not just about gut feeling. You need objective evidence to recognize an impairment loss. Think financial statements, legal documents, that sort of thing.
So no more throwing good money after bad just because I feel sorry for my bri-loving buddy.
Compassion is important, but so is sound financial management. IAS 28 helps you strike that balance.
This is all starting to make sense, but I have to ask, why are we even bothering with all these accounting rules? I mean, who really cares about IAS 28?
That's a fair question. Here in South Africa, understanding IAS 28 is especially important for anyone involved in businesses, particularly those dealing with investments, partnerships, or joint ventures. It promotes transparency, helps you make informed decisions, and ensures you're on the right side of the law.
So it's about playing fair and keeping things kosher.
Exactly. It's about having a common language for accounting, making sure everyone is following the same rules, and ultimately protecting both investors and businesses.
All right, I'm starting to see the light. IAS 28, you're not as scary as I thought you were.
That's the spirit. And remember, this is just the tip of the iceberg. There's a whole lot more to discover in the world of accounting standards.
Well, I'm feeling brave, so let's keep digging. You mentioned earlier that IFRS 9 doesn't apply when you're using the equity method for investments. But what happens when you have those tricky potential voting rights? You know, those options or warrants that could give you more control down the line.
Yes. Those can be a bit of a head-scratcher, essentially. IAS 28 says you have to look at the substance of the situation if those potential voting rights give you, in effect, the same benefits as actual ownership right now. Then you have to factor them in. It's like having a key to the spaza shop, but waiting for the right moment to use it.
So it's about the power you could have, not just the power you actually have right now.
Precisely. And in those cases, you might have to apply the rules from IFRS 9 for those potential voting rights, even though you're using the equity method for the rest of the investment.
Okay, that makes sense. Now, this whole equity method thing, it relies on having up-to-date financial statements from the associate or joint venture, right? What happens if their financial year doesn't line up with yours? It's load shedding sometimes, Brew. Someone's books are always late.
You're not wrong about that. IAS 28 is quite practical in this regard. It says the associate or joint venture should ideally prepare statements that match your reporting date. But if that's not possible, well, let's just say if Escom had a hand in it, there's some flexibility.
So they can't just send me their statements from 3 Christmases ago?
Definitely not. The difference can't be more than 3 months, and it has to be consistent from one period to the next. And of course, you have to adjust for any significant events that happen between their reporting date and yours.
So it's a bit of a balancing act, making sure the numbers are timely, but also allowing for some real-world flexibility.
Exactly. Now, another important aspect of consistency is that IAS 28 is very clear about using the same accounting policies for similar transactions, whether it's in your own books or when looking at your associates or joint ventures financials.
So no playing fast and loose with the rules just because it's someone else's company.
Nope. Everything has to be apples to apples, so to speak, if your associate or joint venture is using different accounting policies, which can happen, especially with smaller businesses. You have to make adjustments to bring them in line with yours.
Okay, so it's about painting a true and fair picture, even if it involves a bit of number crunching behind the scenes.
That's the goal. It's about making sure the information you're presenting is comparable and reliable, so investors and other stakeholders can make informed decisions.
Now, let's talk about those tricky preference shares. You know, the ones that get paid out first in the pecking order. How does IAS 28 handle those?
Good question. If your associate or joint venture has preference shares that are classified as equity, you have to factor those dividends into the equation when calculating your share of the profit or loss, whether those dividends have been declared or not.
So even if those preference shareholders haven't gotten their slice of the cake yet, I still have to account for it.
That's right. It's about recognizing the economic reality. Those preference shares represent a claim on the company's profits, and that needs to be reflected in your accounting.
Okay, fairness for everyone. Even the shareholders at the front of the queue. Makes sense. We talked about those doom and gloom impairment losses earlier, but IAS 28 also mentioned something called recoverable amount. Is that like a glimmer of hope in the darkness?
You could see it that way. When assessing if your investment is impaired, you don't just look at the current losses, you also consider the recoverable amount. Basically, what you could realistically get back from the investment, either by selling it or through future cash flows.
So it's like saying, okay, things are bad now, But could this Shizenyama spot make a comeback with a new menu or something?
Exactly. You have to be realistic, but also consider the potential for things to turn around. To figure out this recoverable amount, you need to do some forecasting,
Yeah.
looking at those future cash flows and the ultimate sale value, all discounted back to the present.
Sounds a bit like predicting the future. Do I need a Sangoma for this?
No Sangoma needed, but definitely a good financial model and some solid assumptions. Remember, it's all about estimates and using the best information available. And the good news is that if things do improve, you can actually reverse an impairment loss, recognizing that recovery in your books.
So it's not all doom and gloom after all. There's a chance for redemption, even for struggling Shizenyama spots.
Absolutely. Businesses can go through tough times, but that doesn't mean they're destined to fail. IAS 28 acknowledges that reality, allowing for both the recognition of losses and the potential for recovery.
I like the sound of that. Now, I'm just thinking, if we're using the equity method for formal investments, could we apply these same principles to other situations, like those more informal partnerships that are so common in South Africa? Like that time I helped my neighbor fix his roof, and he promised me free borrowers for a month.
That's an interesting thought. While IAS 28 is specifically designed for accounting purposes, the underlying principles of understanding influence, recognizing your share of profits and losses, and assessing the true value of an investment, these concepts can be applied much more broadly.
So whether it's a formal business venture or lending a hand to a friend with a struggling spaza shop, those same ideas of shared risk and reward, of being in it together, those are all relevant.
Absolutely. It's about being mindful of the financial implications of your involvement, whatever form that takes.
Wow, this has been incredibly insightful. It's amazing how a seemingly dry topic like accounting standards can actually reveal so much about the dynamics of business and even personal relationships in our unique South African context.
I completely agree. It's all connected, isn't it?
Well, I feel like I've leveled up my financial knowledge today, thanks to your expertise.
It's fascinating how these accounting principles can be applied in so many different ways.
Absolutely. Sometimes when I'm trying to wrap my head around these concepts, I feel like I need a whole team of accountants just to keep up.
Yep.
But you've broken it down in a way that even I can understand.
Well, that's the goal, to make this knowledge accessible to everyone, not just the finance gurus. Because at the end of the day, whether you're running a big corporation or just trying to make smart decisions with your own money, understanding these principles can make a real difference.
Speaking of making a difference, I've got a question about something that's been bugging me. We've talked about how the equity method gives a more accurate picture of an investment's value. But how do we actually calculate that value? What are the nuts and bolts of the equity method calculation?
Great question. It's all about understanding your share of the associate or joint venture's profits and losses. Let's say you own 30% of your cousin's booming bunny chow business. If their business makes a profit of R$100,000 for the year, your share of that profit would be R$30,000. You would then add that R$30,000 to the value of your investment on your books.
So it's like my investment is growing along with the success of the business. And what if the bunny chow venture isn't doing so well? Let's say they make a loss of R$50,000 instead.
Then you'd reduce the value of your investment by your share of the loss, which would be R$15,000 in this case. It's all about reflecting the true economic impact of your investment, whether it's good news or bad news.
That makes a lot of sense. It's like a financial roller coaster ride.
Yeah.
But at least I know how to track the ups and downs.
Exactly. And remember, this is just a simplified example. There can be other factors that come into play, like dividends paid out or changes in the associate's equity. But the basic principle is the same. You adjust your investment value based on your share of their performance.
Got it. Now let's talk about something that's always a bit of a headache in South Africa. Taxes. How does IAS 28 deal with deferred tax implications related to investments in associates and joint ventures?
Taxes, the ever-present companion of any business venture. Well, IAS 12, another accounting standard, comes into play here, essentially. You need to recognize deferred tax liabilities or assets arising from temporary differences between the carrying amount of your investment in your books and its tax base.
Okay. That sounds a bit complicated.
Mm-hmm.
Can you give me an example that even a tax-challenged person like me can understand?
Sure. Let's say your associate has a piece of land that's recorded in their books at R1 million, but for tax purposes, it's valued at R1.5 million. This difference creates a temporary difference that will eventually reverse when the land is sold.
So, we're talking about a difference between what the books say and what SARS says.
Precisely. And because of this difference, You might need to recognize a deferred tax liability in your own books, reflecting the potential future tax implications of this difference.
So it's like planning ahead for those inevitable SARS encounters.
Exactly. It's about making sure your financial statements give a comprehensive picture, including those potential future tax obligations.
Okay, I'm starting to feel like a tax expert already. But speaking of experts, I've got another question for you. IAS 28 talks about something called control when it comes to joint ventures. What exactly does that mean?
Control in a joint venture is all about having the power to direct the relevant activities that significantly affect the venture's returns. It's not just about owning the most shares, it's about having the ability to make the big decisions that impact the bottom line.
It's like being the captain of the ship, even if you don't own the whole vessel.
Exactly. Now, sometimes there's a formal agreement that outlines who has control. Think of it like a prenup for business partners. It spells out who gets to call the shots in different situations.
Oh, so we're talking about clear boundaries and avoiding those messy business divorces.
You could say that, but even without a formal agreement, you can still assess control based on the facts and circumstances. Do you have the right to appoint key management? Can you veto major decisions? Those are the kind of things you need to consider.
So it's not just about the paperwork, it's about the real power dynamics at play.
Absolutely. And remember, understanding who has control is crucial because it determines how you account for the joint venture in your financial statements.
Okay, I'm starting to see how this all fits together, but what happens when things get a bit, complicated? Like, what if there are multiple investors in the joint venture and everyone has different levels of influence?
That's where things can get really interesting. IAS 28 has guidance on how to deal with these complex joint venture structures. Sometimes you might have joint control, where decisions require unanimous consent from all the parties involved. It's like trying to get a family of 5 to agree on where to go for dinner. Everyone has a say, and things can get a bit chaotic.
I can definitely relate to that.
So,
But sometimes one party might have more power than the others.
right, exactly. In those cases, you need to carefully analyze the arrangements to determine who really holds the reins. It's like that time my uncle thought he was in charge of the family braai, but my aunt was really the one calling the shots.
Sounds like a classic South African family gathering.
Mm.
So it's all about understanding the underlying dynamics, even if they're not always spelled out in black and white.
That's the key. And remember, when it comes to accounting for joint ventures, it's crucial to get the control assessment right because it can significantly impact how you present the venture in your financial statements.
Okay. I'm feeling much more confident about navigating the world of joint ventures now. But before we wrap up, I have one last question that's been nagging at me. We've talked a lot about the equity method, but what are some of the limitations of this approach? Is it always the best way to account for investments in associates in joint ventures?
That's a really insightful question. While the equity method is a powerful tool, it's not without its limitations. One of the main criticisms is that it relies on estimates and judgments, which can introduce subjectivity into the accounting process.
So it's not as cut and dried as some people might think.
Exactly. And sometimes those estimates can be difficult to make, especially when dealing with complex or volatile investments. Another limitation is that the equity method doesn't always capture the full extent of an investor's exposure to the risks and rewards of the associate or joint venture.
So it's like looking at a snapshot rather than the whole movie. You might miss some of the nuances and complexities of the situation.
Precisely. And this can be particularly relevant in situations where the investor has significant influence over the associate's operations, or is heavily reliant on the venture's performance. It's like relying on the highlights reel instead of watching the full rugby match. You might get a sense of the score, but you miss all the strategic plays and heart-stopping moments.
That's a great analogy. So while the equity method is a valuable tool, it's important to be aware of its limitations and use it judiciously, especially when dealing with complex investment scenarios.
Absolutely. And remember, in some cases, other accounting methods might be more appropriate, depending on the specific circumstances of the investment. It's all about choosing the right tool for the job.
I'm starting to feel like I could tackle any accounting challenge now. But before we get too carried away, I think it's time for a quick water break. We've covered a lot of ground today, from the basics of the equity method to the complexities of joint venture control. When we come back, I want to dig a bit deeper into those potential voting rights you mentioned earlier, and maybe explore some real-world examples of how IAS 28 is applied in South Africa.
Sounds good to me. I'm always ready for a deeper dive into the fascinating world of accounting standards.
All right, I've refilled my Rooibos tea, and I'm ready to dive back into the world of IAS 28. Before the break, we were talking about potential voting rights and how they can sometimes make things a bit tricky. Can you remind us what those are all about and give us a South African example to help us understand?
Sure, potential voting rights are basically rights that you don't currently have, but could acquire in the future, like through options or warrants. Think of it like this. You and your friends decide to start a Coda business. You initially only invest enough to get a small share of the company, but you also negotiate an option to buy more shares later on, if the business takes off.
So it's like securing a bigger slice of the Coda pie if things go well.
Exactly. Now, under IAS 28, you don't necessarily have to account for those potential voting rights right away, but you do have to consider their substance. If those rights give you significant influence over the company, even before you exercise them, then you might need to apply IFRS 9 and factor them into your accounting.
It's about the potential power you hold, not just the actual power you're currently wielding.
Precisely. And this can be a bit of a judgment call, as you have to assess the likelihood of those rights being exercised and the impact they would have on your influence.
I see. So it's like trying to figure out if you're just a silent partner in the Coda venture or if you're about to become the head chef, even if you haven't officially stepped into the kitchen yet.
That's a great way to put it. Now, let's move on to some real-world examples of how IAS 28 is applied in South Africa. One area where it plays a significant role is in the mining industry. Many mining companies have investments in joint ventures, especially when exploring new mineral deposits or developing complex projects.
So it's like when two mining giants team up to dig for gold, but they need to figure out how to split the spoils.
That is a simplified way to look at it. But it's crucial for those companies to apply IAS 28 correctly, to ensure their financial statements accurately reflect their share of the joint venture's assets, liabilities, revenues, and expenses.
Okay, that makes sense. And what about other industries? Is IAS 28 relevant for smaller businesses as well?
Absolutely. Think about the thriving entrepreneurial scene in South Africa. Many startups seek funding from venture capitalists or angel investors, often giving them a significant stake in the company in return. These investments often fall under the scope of IAS 28, as the investors might have significant influence over the startup's operations.
So even those small businesses selling delicious samosas on the street corner might need to know about IAS 28.
If they have investors with significant influence, then yes, they should be aware of the standard and how it applies to their situation. It's all about transparency and accountability, regardless of the size of the business.
I'm starting to see that IAS 28 is like a chameleon. It can adapt to all sorts of business scenarios in South Africa. But I have to ask, with all this talk about rules and standards, is there ever any room for creativity in accounting? Can you ever bend the rules a bit to make things look better?
I see you're trying to get me to spill some accounting secrets. But seriously, while there might be some flexibility in how you apply certain accounting principles, the fundamental goal of IAS 28 and other standards is to provide a true and fair view of a company's financial position.
So, it's like playing a game of chess. You have to follow the rules, but there's still room for strategy and clever moves.
That's a good analogy. You can be creative in how you structure transactions or present information, but you always have to stay within the boundaries of ethical and legal accounting practices.
Okay. I'll make sure to keep my accounting moves above board. But speaking of moves, I think it's time for us to wrap up this deep dive into IAS 28. It's been an eye-opening journey, and I feel like I've learned a lot about navigating the world of investments, joint ventures, and all those tricky accounting concepts.
It's been a pleasure sharing this knowledge with you and our listeners. Remember, while IAS 28 might seem like a dry and technical topic at first, it's actually filled with fascinating insights into how businesses operate and interact in our unique South African context.
Absolutely. And I encourage our listeners to explore these concepts further and see how they can apply them to their own businesses or investment decisions. After all, knowledge is power, especially in today's dynamic economic landscape.
Well said. And until next time, may your investments flourish and your accounting records be always in order.
Sharp. That's all the time we have for today's deep dive. A big thank you to our expert for breaking down this complex topic and making it so engaging. And to our listeners, remember to subscribe and join us next time for another deep dive into the world of knowledge that matters. Until then, stay curious and keep those entrepreneurial spirits burning.